clicker. Let's see how it works. Okay. So I'm Andrew Obin. I'm Managing Director at Bank of America Equity Research. I cover what's called the category called electrical equipment and multi-industry. So I cover companies like General Electric, Honeywell, Emerson, Rockwell Automation, and over the past several years, as software has become more and more central to what these companies do, I actually started covering industrial software companies as well, like Ansys and Aspen and PTC. So I guess the goal of the presentation is that I'm going to talk about the macro environment, specifically focusing on CapEx, inflation, and then I'm going to segue into, how does Wall Street think about software valuations, and sort of, big industrial companies getting into software, I think was more of a financial focus. And I've been lucky enough to be invited here over the past couple of years, so just want to sort of describe what has changed over the past 12 months. I feel there is a lot more visibility on CapEx going forward. I think there is a lot more inflation, and you did see that I think that's a huge source of uncertainty. And, from a Wall Street perspective, there has been a lot more software M&A, right? Industrial companies buying software companies. And of course, if you care about software and if you care about software stocks, there's been a bit of a sort of NASDAQ sell-off, to use sort of a term like that. So the first chart that I have goes over a long-term CapEx outlook for the US. And I want to say that I am actually very, very positive long-term. I think that we are on the cusp of the strongest CapEx cycle in probably 20, 30 years. I just came back from Hannover Messe. What I can tell you is that met with a lot of, I guess, folks in the room. I think near-term visibility is actually okay, albeit everybody recognizes a huge, huge amount of uncertainty. So I think the real trick is bridging this outlook for the next month or two with the outlook, for the next 3 to 5 to 10 years. So what I want to focus on, why are we bullish? So this chart really focus on the upper left corner, trend over the last 20 years, right? You have shrinking tech capacity in the US. That has been the single largest driver of deindustrialization in North America, globalization of supply chains, and CapEx focusing on productivity rather than capacity additions, right? And you can actually see at the bottom of the chart, growth in US manufacturing capacity, right? You see steady growth in the 80s and the beginning of the 90s. You see a big spike in capacity additions, which is actually the tech bubble in the US. And then starting in 2000, between the tech bubble collapse and China joining WTO, you can actually see that it's been very little new capacity added in North America. Of course, that means that the focus has shifted away from capacity to productivity. And believe it or not, in this environment with very low top-line growth, it created new operating paradigm where companies were able to focus on efficiency in a relatively low growth environment. And if you know anything about your companies, margins have been going up and up and up for 20 years. So it's been pretty bad in terms of CapEx, but actually incredibly good for operating efficiency. So we think this paradigm is almost done. We think going forward, things are going to look very differently. And specifically, an upper right corner, what you do, and by the way, if anybody wants to email me, happy to send you the data. What you have is that we looked at growth in manufacturing CapEx. So from 2007 to 2019, the CAGR was 2.8%. If you look at the semiconductor announcements, right, and this is TSMC, Intel, Samsung, this is what has been announced already. There is some uncertainty how much supply chain it's going to drag with it, right, how many fabs TSMC is going to add. So I have a percentage point here adding to growth over the next 5 years, maybe 1 to 1.5 percentage points. Second, we do make an assumption that there's not going to be a lot more outsourcing, right? We're not saying things are coming back, but what we are saying is that there is this economic measure called mix of imported intermediary goods. Right now, U.S. imports roughly a quarter of components of what we make, is going to stay stable, and it actually has been stable over the past several years. So if that stays stable for the next 5 years versus the past decade, adds another percentage point to growth, right? And then finally, we have been spending, the government has been spending. So the announced U.S. stimulus adds probably another 1 to 1.5 percentage point to growth. So your starting point for the past decade plus, you grew at 2.8%. If you take everything that has been announced already, right, that gets you to growth 6-7%. So the rate of growth of CapEx, based on what has been announced already, we think easily can double over the next 5 years. And with that, I want to add that this does not include automation spending that we think is going to be driven by inflation, which I will touch. And certainly this does not touch any potential reshoring, right, that could come from adding trailing edge chip capacity in North America, which is also happening. So I think this is a fairly conservative base case scenario. Now, if you go to the next slide, we do think CapEx is going to look different. Structurally, we do think there will be a lot more additions to equipment and structures, but we also think that over the past, this has been going on for 50 years, you can see intellectual property, right? The industry has changed a lot. Back in 1970, intellectual property represented maybe 16% of fixed assets for manufacturing companies in the US. Today, it's 34%. So from that perspective, I think the genie is out of the bottle. Even though we are going to spend more on sort of equipment, we also continue to spend a lot more on digital. So let's just talk about what's happening with inflation. So chart on top, right, it's a big issue. And I think it's a huge source of uncertainty in the market. It's a huge source of uncertainty in the economy. So on top, you have U.S. manufacturers producer price index. And in April of 22, it hit 18.6%, which I think has been the highest number in over 40 years. So I think all of you lived this. And on top of it, hopefully you live that part as well, U.S. manufacturing wages have been accelerating and also hitting sort of 40-year highs. Now, if you are sitting at the corporate level, right, and if you look, what does it do? So next slide is actually what we did. We aggregated gross margins for the companies that we cover. And you can see, surprise, surprise, right, inflationary pressures. Now 2020 decline is COVID, but you can see that despite fairly good top line, right, gross margins continue to decline as inflation is putting pressure on what's happening. And frankly, my view is that this is structural, right? The paradigm that I have described over the past 20 years, very little investment, focus on efficiency, right? Industrial margins went up as a straight line for 20 years. We think this is over. We think that you will have to reinvest in working capital. You will have to reinvest in inventory. And frankly, if you are going to sort of break up your supply chains and localize them, you're going to create natural inefficiencies, and you are going to bring back capacity to places like Europe, maybe places like North Africa and Europe, and in the US, right, maybe North America and Mexico. All of this costs money. All of this is going to impact margins, but we do think you are going to get a lot more growth. So that's going to be the trade-off, right? For the past 20 years, very little top-line growth, right? Great margins. I think going forward, at least, for the next 5 years, let's call it, I think you're going to get a lot more growth, assuming we get whatever air pocket is coming our way. But margins, I'm not sure margins are going to be sustainable. And I also think you will have to carry permanently more working capital, more inventory, right? So I think that's the new paradigm. So the next slide is actually very interesting. The reason we are excited, is just I've outlined to you the base case for CapEx. So we also ran numbers and we looked at correlation between wages and automation spending and efficiency spending at factories. It takes 2 years for corporates to figure out that higher wages should lead to automation spending, right? And I've heard anecdotes. it's just, look, companies are very, very slow moving, and it just takes 2 years. But the point is that what is happening right now, these wages that are the highest in 40 years are going to drive CapEx in 2 years, right? Spent on automation. And the reason we know we're not making it up, I was at an analyst meeting for one of the largest companies that I cover, company that it's at this meeting. They are doubling their CapEx spending on automation in 22. They're doubling it again in 23. And this is all a result of what transpired in 21, right? So, you know, the 22 stuff is not even in the plan. So we actually think that we're going to have a lot of automation spending, you know, assuming people get semiconductor chips. So the next one is, you know, and interestingly enough, we listen to earnings transcripts. I don't know if many of you do it, but, you know, public companies hold conference calls with investors and analysts, and you can actually use software, I think like basic form of AI, to sort of track keywords, right? And you can see, guess what? Automation, the mention of automation on these calls is going up, and it's going up dramatically. The other thing what you can also see in the data, historically, U.S. has not been a country that has used a lot of robotics, right, compared to countries like Korea. I think there was a Wall Street Journal article about it recently. So you can look at the data. We are actually importing more industrial robots. So not only companies are talking about it, they are actually doing something about it. So the next slide, just going to shift a little bit, just go into software. And manufacturers today, just to give you a sense, property, plant, and equipment spending for manufacturers today is $200 billion a year, roughly, of which only $100 billion is equipment. Manufacturing companies today spend roughly $140 billion a year on software, right? So manufacturers today spend more on software than they spend on equipment to actually make things. So that's, I think that's very interesting. What we think is also interesting, and I know it's a huge focus for a lot of folks in the room, is that how little oil and gas industry spends. So you can see is that in 2014, before oil prices collapsed, oil and gas industry spent roughly the same amount as manufacturing industry on PP&E. But on the same, you know, it's gone down, it's probably going to go up. So on the same basis, just appreciate that manufacturers spend $140 billion on software. Oil and gas industry spends a whopping $9 billion on software. And I think that's why, frankly, oil and gas is such a huge focus for a lot of the stands here because, you know, not very efficient. We ran numbers. It takes the same number of people to lift a barrel of oil out of the ground today as it did 40 years ago, right? If I think any of your companies had this kind of efficiency, they probably would be out of business. Another very interesting way to think about oil and gas industry versus manufacturing, right, is that back in 98 when oil was, I don't know, like $14 a barrel, actually oil and gas and manufacturing spent relatively the same amount of money on IP, right, on intellectual property. And then manufacturing industry became a lot more mature. They were not allowed to grow. They had to become more efficient to survive. So you can see the spending on IP has been going up for the past 20 years, right? Oil and gas industry went through the growth cycle. So it was growth, growth, growth. So no need to spend on efficiency. So we actually think that between shareholder pressure to spend money in a more efficient way, between energy transition, between requirements to manage emissions better, we actually think oil and gas industry is likely to shift in a more mature stage. And actually, we're very bullish about what's going to happen there, even more bullish than manufacturing, because they have to become more efficient. And becoming more efficient, we're not making a call how much money they're going to spend. We are making a call that they are going to spend money very, very differently going forward and spend a lot more on automation and software. So this is the setup. So as you can see, you know, we are arguing more CapEx, and software will continue to be a key area of spending for the corporates. So guess what? I'm not the only one figuring it out. You know, corporates have figured it out, and you can see industrial firms' acquisition of software are going up and up and up. It's becoming bigger and bigger theme, right? Over the past couple of years, There are some key transactions that I think all of you know, and we think there's going to be more. So we think software is a key area of growth. There's more CapEx coming. Companies have to figure out how to spend money more efficiently, and they'll continue to buy software assets. The other thing is that I think the title of this slide is a little bit misleading. It's still traded premium multiples. Actually, they do trade at a premium multiples of EBITDA. But what's interesting, if you look at software companies on trading on DCF basis, actually software assets are very, very cash generative. So from that perspective, the valuation gap between industrial companies and software companies is a little bit narrower. And if you look, this is how Wall Street looks at valuations, right? EV, EBITDA, enterprise value, which is equity value of the company, plus net debt, divided by EBITDA, which is earnings before interest, taxes, depreciation, amortization. And as you can see, for industrial companies, the market is quite rational. If companies have higher return on tangible assets, the market places a higher multiple on it, right? But you can see that the three software names that we cover, Aspen, Ansys, and PTC, trade actually quite a bit above industrial companies, and that's because software assets over time grow quite a bit faster. They grow, at least 2 times. On a previous slide, you can see that software spending has grown at twice the rate of underlying CapEx, and that's so you can see that. And then the big debate in my world is, this software crash. You see a lot of it on CNBC. So does this mean it's a great time for industrial companies to go and buy software? And the answer is maybe, because the software multiples have collapsed, except they didn't. Software multiples have gone back to where they were pre-COVID. Now, I think the multiple compression is more pronounced as SaaS names, even more pronounced with SaaS names that sort of fall short of the rule of 40 or don't make money. But the issue is, I think if corporates were making a decision whether to sort of make or buy software, right? On the surface, it looks like, oh my God, look at the multiples, they've all gone down. You're where you were 2 years ago, right? If 2 years ago you couldn't pull a trigger, guess what? Valuations are not that different today from where they were 2 years ago. Now, and the issue is, and I've had the same slide a couple of years ago, that's the issue. The issue is software continues to grow faster than hardware, albeit we are quite a bit more constructive on hardware growth. And this sort of compares to you, where you were 7 years ago in terms of market caps versus where you are today, despite this big decline in software multiples, right? And the idea is that a lot of the software names are worth 2, 3, 4 times what they were worth 7 years ago. And this goes back to my point, your decision make or buy, right? And it's a hard decision, right? Because making it culturally is very, very difficult. I cover a number of companies that have really struggled culturally, right? Building a software culture inside a diversified industrial conglomerate is very tough. Buying things are also tough because, software engineers hate guys on the factory floor, right? It's just they don't get along. So you have to figure out the culture. You have to get that right. But the point is, the longer you wait, the tougher it gets because software just outgrows hardware and will continue to do so, even as hardware probably going to look a lot better than it did over the past 20 years. So with that, just to summarize, look, our view, very optimistic about CapEx, very optimistic about CapEx in America. We think the paradigm over the past 20 years is going away. We think it's going to look very different, at least this decade. Having said that, software and automation continues to remain very central to what these companies do, and we think it will continue to outgrow core equipment spending. And all of you guys are still not off the hook thinking how to sort of strategically implement it inside your companies. And with that, I want to thank you.